So for part 3, we're going to look at a worked example of the preparation of the bank reconciliation statement. So the question says, examine the cash book and bank statement below. Prepare a bank reconciliation statement starting with the cash book balance. And if we recall part 2, we said that we could start with the cash book balance or with the bank statement balance. So in this question, they are actually asking us to start with the cash book balance. So let's examine the cash book. We have the date, particulars, folio number or folio, bank, date, particulars, folio, bank. And we know from examining the cash book that there are two sides to the cash book, the debit side and the credit side. We already established in parts 1 and 2, that the debit side of the cash book is for the recording of receipts, and the credit side of the cash book is for the recording of payments. So all these debit entries represents money received. These credit entries represent monies paid out or payments made. So we start with our opening balance of April 1st, and it's the balance brought down, it's $1,200. On the 5th of April, we have particulars J. Smith, $50. 8th of April, M. Shaw, $235 on the debit side of the cash book, which means it's a receipt. 8th of April, K. Martin, credit side of the cash book, $78, which means it's a payment. The 17th of April, L. Mohan, $30, receipt. 10th of April, S. John, $440, payment. 30th of April, R. King, $500, another receipt. And we add all our debits, which gives us a total of $1,965. We add all our credits, 50, 78, 40, and subtract that figure from 1,965, and that gives us our balance carried down, which is $1,397. Note that the balance carried down on April 30th becomes the balance brought down on May 1st. So this would be the balance for the next corresponding period. So the balance carried down or closing balance in April becomes the opening balance for the month of May. Now let's have a look at the bank statement. If we look at the bank statement, the same way we had debits and credits in the cash book, we can see debit entries and credit entries in the bank statement. So here we have April 1st, the balance brought forward of $1,200. 6th of April, a check, $50, and remember debits represent withdrawals, while credit entries represent deposits, right? When we're looking at the bank statement. So check number 23 was written for $50. That was a withdrawal. On the 8th of April, cash was deposited into the bank of $235. On the 8th of April as well, a check was written for $78. On the 12th of April, another check was written for $440. On the 15th of April, there was a standing order for insurance of $100. On the 21st of April, cash was deposited into the account, the sum of $30. On the 22nd of April, a loan payment standing order was deducted or withdrawn of $200. And on the 29th of April, salary was credited of $1,800 was credited to the account. So all the debits are deducted from the balance while all the credits are added to the balance. So for example, we have here $1,200, a withdrawal of $50, so our balance is now $1,150. $1,150 with a credit or an increase or a deposit of $235, and our balance is now $1,385, and so on and so forth. So we can see now here that our balance in the bank is $2,397, while our balance in the cash book is $1,397. So there's a discrepancy. Our bank statement balance is not the same as our cash book balance. Therefore, we need to prepare a bank reconciliation statement, and we were asked to prepare the bank reconciliation statement starting with the cash book balance. So we have to prepare the bank reconciliation statement starting with the cash book balance in order to reconcile both balances of $1,397 and $2,397. So let's follow the procedures that we have been taught in video 2 and perform or calculate and prepare the bank reconciliation statement. So here we are going to check each entry in the cash book against the entries on the bank statement so that those which do not appear on both can easily be seen. And as we saw in part 2, common practice is to tick off entries that appear in both the cash book and the bank statement. The second step, which is update or revise the cash book, we are not interested in performing this step because the question did not ask us to update or revise the cash book. The question says, prepare the bank statement balance by starting with the balance as per cash book. So right now we are going to follow the step 1 in the procedure for preparation of the bank reconciliation statement. As indicated in the procedure, we are now going to tick off the entries that appear in both the cash book and the bank statement, and as the second step I like to do is circle those entries that are different. So let's examine the entries and see if we can determine what entries are similar and those entries which are different. So let's proceed. We have our balance. We have J. Smith. We are looking at the date, April 5th, the amount. So on April 6th, we have an amount of $50. And how do we know that this $50 corresponds to this $50? There are two ways. We look at the date. So on the 5th of April, a payment was made to J. Smith and the amount was $50. So this entry represents a credit entry in the cash book. We look at the bank statement, and if it's a credit entry in the cash book, there should be a corresponding debit entry in the bank statement. And here we have a debit entry of $50 in the bank statement by way of a check written on the 6th of April. So it is safe to assume that this check number 23 was written for the payee J. Smith with the amount of $50 on April the 5th, and it is reflected in the bank statement on April the 6th. We look at April the 8th, so we have a receipt in the cash book of $235 and a corresponding deposit into the bank account of $235. We look at April the 8th. In the cash book, there's a credit entry of $78. There is a corresponding debit entry of $78 by way of check number 24 in the bank statement. In the cash book, there is a receipt of $30 from El Mohan on 17th April. And if we look at the bank statement, we are going to see a cash deposit on the 21st of April in the amount of $30. Now, you should note here that although this money was received on the 17th of April, it was not deposited into the bank until the 21st of April. And this is just an example of one of the reasons why both the cash book and bank statement balances may vary. However, not in this case, because the amount is accounted for on both the bank statement as well as the cash book. If we examine the cash book again, we are going to see payment for $440 and a corresponding debit entry in the bank statement of $440. If we look at the cash book, there is a receipt of $500 on April the 30th, which does not show up on our bank statement. So this is not reflected in our bank statement. So we are finished with the cash book and we realize that there is one item in the cash book, a debit entry, a receipt of $500, which is not anywhere on the bank statement. It has not yet been, or it has not yet been, it does not yet appear on the bank statement. If we look at the bank statement, we see three transactions, a standing order for an insurance payment, as well as a loan payment and a salary deposit, which are not accounted for in the cash book. So where do we go from here? We examine those entries and try to determine whether they are representative of receipts, payments, outstanding or unpresented checks, outstanding or unpresented deposits, standing orders, credit transfers, interest paid, interest received, or bank charges. In so doing, we look at our formula so that we can make a determination on what the formula is for preparing the bank reconciliation statement. So we take the balance as per cash book, add all the outstanding or unpresented checks, subtract the unrecorded deposits, and then we will arrive at our balance as per bank statement. So as you would recall, part 2 of the question says, prepare a bank reconciliation statement starting with the cash book balance. What cash book balance are they speaking about? So there's a balance here, there's a balance here, and there's a balance here. The cash book balance that they are speaking about is the balance that is carried down from the previous period into the new period. So the balance carried down or carried forward from the previous period would be the balance brought down into the new period. And this is the cash book balance which we have to start with to prepare the bank reconciliation statement. So looking at the formula, let's see if in our part 4 of the series, if we can reconcile the balance as per cash book with the balance as per bank statement.